The other thing you can look at for your retirement portfolio would be a way where you can buy packages of securities, and that would be through mutual funds. You have to be very careful about this. You know, there are what are called active managed mutual funds and passive managed mutual funds. A passive managed mutual fund is what you would refer to as an index fund. There's no manager. The mutual fund will be tied to a particular index, usually the S&P 500, and the performance of that index is what your return will be. Over the last 6 years, the S&P 500 has gone up 250%. Pretty decent, okay? While bond yields have continued to move lower in here. So what we found out, a report that just came out this week, is that the other side, the active management accounts, these are the ones where there's a manager who gets paid a lot of money and gets big fees and stuff like that. Actively managed accounts, only about 12% of them outperform an index, okay? Now, you're going to be paying probably as much as 2% in annual fees on a managed fund. On a passive fund, an index fund, your fees are each year going to be below 1/4%. The great John Bogle, who was the father of index investing, said there are two things that will ruin your investments, and none of them have to do with stock market volatility. One is taxes, and the other is inflation. And you need to protect yourself from, well, one is taxes and the other is fees. And so you've got to fight the fight on fees. You've got to know how much you're paying in fees, which, you ever tried to ask your company administrators what the fees are on your 401k account? That's more closely guarded than most of the important information in Washington, D.C. You can't get your hands on those numbers. They're practically impossible. So it's a real challenge to do that, but on mutual funds, it's very simple. If you have any mutual funds, you probably have received in the mail the prospectus for the mutual fund. And I know when you all get a mutual fund prospectus, you immediately sit down and read it from one cover to the other, right? All you really need to do is read the inside front page of the prospectus. And it's the same on every mutual fund. It's a standardized form that will tell you exactly what the fees and expenses are going to be on that fund. And then it will give you comparable information with industry averages, and it will help you understand how much you're letting go on these funds. So be very careful about that stuff, and try not to get eaten up by fees and expenses. I would guess 75% of all index mutual funds are tied to the S&P 500. Now, you'll find a lot of sector funds out there, but if I were, I'm going to give you the advice of Warren Buffett here, because this is really appropriate. Now, Buffett, of course, is like the #2 wealthiest man in the world, okay? And he says, if you don't know Buffett, you should learn more about him. You should go to his company website. His company is called Berkshire Hathaway. That's one we should have put up, but that's okay. Berkshire Hathaway, that's Warren Buffett's investment company. And every year he writes a letter to his shareholders that is put on the website, and it is fantastic. You learn so much about investing from the greatest investor of all time. And I think it was in his last letter that came out just a couple of weeks ago, or maybe the year before that, and he talked about, Buffett has always said, I'm going to die penniless, because he's going to give all of his money to charity. And the charity he will give most of his money to is the charity run by Bill and Melinda Gates. They are good friends, and that's where he believes in what they do. And he said, but I am going to have bequest in my estate that will go to, you know, some people that have been important to me, family members and stuff like that. And he said, I'm going to ask that the people who manage my estate when I'm gone, give them a letter that I've written. And what he said in that letter is that I would encourage you to invest your money that you're receiving from me in this way. Put 90% of it into an S&P 500 stock index fund, and 10% into an intermediate term bond fund. If that's advice you get from the wealthiest man in the world for free, okay? And there's a lot to be said for that. He didn't say put it into a technology index fund. He didn't say to put it into a retail store index fund. He said put it into the S&P 500. Own the 500 largest companies in America, all in one fell swoop, that's very tax efficient, has hardly any fees at all, and just leave it alone. Okay? So that's what I think you would find. Now, there are other indexes that some of these funds are tied to, but far and away, I'm probably really lowballing it when I say 75% are tied to the S&P 500.